Hello, and welcome to AML Singapore's YouTube channel. Today, we are back with one such topic, trade-based money laundering. Throughout this video, we will explore its concepts, identify potential red flags, and discuss some effective strategies for mitigating the TBML risks. Before diving into details, let's first understand what trade-based money laundering is. Trade-based money laundering is a method criminals use to launder illegal money under the cover of business transactions. There are legitimate businesses that route the criminal proceeds using fake commercial dealings. Sometimes, the criminals set the shell or shelf companies to move the illegal funds in the name of business deals. Now, let's look at the techniques used for trade-based money laundering because it's important to detect and prevent the disguising of dirty money under cover of business transactions. Technique 1. Over-invoicing. In this technique, the exporter sends inflated bills to the importer. The invoice consists of an increased quantity of goods, and the payment exceeds the actual value of the goods purchased. With legit documents having incorrect values, the importer transfers the illegal funds from one country to another through legit financial systems without being caught by the authorities. The exporter receives the excess money, which is not due but transferred in the garb of invoices. With an invoice as a supporting document, the illegal money changed the country and also entered into the financial system. Technique 2. Underinvoicing. In underinvoicing, the invoice is sent to the importer with bills that are less than the goods shipped. The importer receives the goods worth higher value, which can later be sold in the local market in black, without recording the actual value in the books. Technique 3. Multiple invoicing. One invoice may be legal but is issued many times in this method. The same invoice is sent to multiple customers without actual shipment being made to all these customers. Against the same invoice, under the name of supply of goods, the exporter receives a higher value than the goods actually exported. Using this technique, the criminal proceeds from multiple accounts from different countries end up concealing the nature and origin of the illegitimate source. Technique 4. Quality deviation. A common trade malpractice is to ship goods of lower quality instead of the high quality mentioned on the invoice. The exporter receives a higher value from the importer, as misrepresented on the invoice. Again, this is the technique money launderers use to move high-value dirty money from one country to another. You can detect these techniques as they take place. There are red flag indicators that allow you to recognize suspicious activities hinting towards TBML. Let's check some of those indicators. 1. Businesses that continually show losses and manage continuity. 2. New businesses showing unusually high profits and engaging in high-volume transactions. 3. Businesses that use complex corporate structures without a reasonable ground. 4. Companies using fake addresses or multiple companies having the same address without any reasonable business rationale. 5. Business that doesn't have an online identity or cannot be located on Google Maps. 6. Dormant company suddenly starts engaging in high volume of transactions. Businesses that present themselves as associated companies, which is not true. Measures to prevent trade-based money laundering. It's not enough to just detect the warning signals. You have to act against these red flags and step up to combat trade-based money laundering. The best ways of doing that are: 1. Customer due diligence. It allows regulated entities to identify the customers and the beneficial owners and verify their identity and determine the person's legitimacy. Further, the outcome of the sanctions screening and adverse media checks can help you find the customer's risk rating and decide whether to deal with the customer or not. 2. Ongoing monitoring. By continuously monitoring the transactions, you can ensure that the customer's activities align with the customer's risk profile and expected activities as determined while establishing a business relationship. It helps to detect any unusual activities or inconsistent customer behavior. In this video, we made you familiar with trade-based money laundering and its different techniques. You can detect red flags that suggest trade-based money laundering activities. According to that, you can create and implement a robust AML/CFT framework, including a comprehensive CDD process and strict ongoing monitoring. Hope you find this video useful. Stay tuned for more informative videos.